as your executive director for the Hispanic Wealth Project. And today we're going to have our Q4 economic update. And this is an opportunity that we provide to all of our members and those that follow the Hispanic Wealth Project, an opportunity to stay ahead of really the economic trends. We're very honored to have with us today Luis Alvarado, who's head of Global Fixed Income Strategy. He's a Global Fixed Income Strategist for the Global Investment Strategy Group at Wells Fargo Investment Institute. Luis, thanks so much for joining us today.
Yeah, my pleasure, Jason. Thanks for having me. It's going to be a packed agenda, lots to cover today.
Excellent. So today, everyone, what we're going to have is an opportunity to hear from Luis. He's going to give us a deep dive on what we're seeing in the economy. And from there, we're going to have an opportunity for Q&A from our audience. I also have some questions that I've prepared myself. And so this is a great opportunity for our members to really close out the year, having a great perspective on what's going to happen, hopefully into the future. But as you know, Luis, as we're many of our members come from the real estate sector. Many are also small business owners. And looking at it's been about like 16 months really where this sector specifically has really taken a hit, as we know, because of higher interest rates and mortgage rates being where they are today. And we're seeing some slight drops in that. So this is some good news there. And so I know that this audience is very eager to see, is 2024 an opportunity for things to kind of change and really turn things around. So obviously a lot of what we're hearing today is taking an analysis of what we're seeing. And but you are a professional, know how to frame everything here today. And so we're honored to have you. And so today I'm just going to turn it over to you and let you go through the information that you prepared for us. Thank you, Luis.
Yeah, thank you for that great intro, Jason. My pleasure. My goal is to try to navigate some of the story pretty much of what has happened in 2023. And then also kind of tell you where we're coming from in 2022. All right, perfect. So don't worry too much about the columns. And then what's most important is what's going to happen in 2024, of course. So obviously, we know that we're coming from an environment where growth was not optimal, but it also wasn't subpar. We've been waiting for that sort of recession to happen in the U.S. economy. If you remember, a lot of 2023 story and in the media outlets was mostly about soft landing versus hard landing, and then kind of the Fed at the center of everything. We also heard about inflation, and we're going to tackle inflation quite a lot. Obviously, we finished 2022 above 6%. We're about 3.5, 3.6% right now. And then the expectation for 2024 is that inflation trend to continue to go downwards, which is a positive for the economy, of course, hopefully giving the Fed some room, some amplitude to be able to cut rates. And then also the unemployment rate, we'll obviously talk about this. Obviously, job market is still very resilient. That allows consumers to continue to spend. And then something in here that was interesting as well was the dollar. The dollar was strong in 2022. It continued to be relatively strong in 2023 relative to the euro, to the yen, to the British pound, which is kind of like some of the other benchmark currencies. And we'll see kind of the dominance of that dollar stay with us for the first half of the year. And then towards year end, things are going to change. So think about 2024 as a tale of two halves, and hopefully you can follow the story along. So what's happening with GDP? Well, we just have fresh off the oven data about GDP in the third quarter, continuing to beat expectations of 5.2% annualized pace in the third quarter. And it's been driven by that strong personal consumption, right? Growth, however, is expected to slow down some in this fourth quarter, right? Why? Well, we're going to see some emerging financial strains. We're going to still see elevated interest rates and then tightening of liquidity conditions behind the scenes. The liquidity that is in the economy, which could be different from the liquidity in financial markets, is also decreasing. And that, in our belief, is kind of laying the groundwork for a difficult 2024. Again, it's going to be a tale of two halves for 2024. The first half giving us some problems as we continue to see a gradual slowdown from the economy, especially on the consumer, which has been the element that has kept pretty much the economy going. And this is kind of the red bar that you see here in the chart. And then our expectations for 2024, of course, as we see economic growth decline. However, because it's a tale of two halves, the second part of the year, we expect to see a gradual recovery in economic growth, and that will also help financial markets boost. So how do we look at this? Like, why are we in our base case scenario expecting a difficult 2024? And for that, we use one simple index. There's multiple other indexes that we use, but looking at the leading economic index, LEI, it has gone negative. It's been negative for 17 consecutive months, but also every time that the LEI index drops below zero and it stays in negative territory, a US recession follows. So far, we are in this sort of exception, but in our belief, the signal is pretty clear. There's something that eventually will break, and it's a combination of all those things coming in together. Again, the consumer is the key and has taken a key role for all 2023. However, if we believe that a lot of that consumption has been done on credit cards and those credit cards are getting to their maxes, if they're deploying some of their savings, if it's pretty much the top 20 percentile of like wealthy individuals that are keeping the economy afloat, because the other four cohorts, the other four, quintiles are pretty much not being able to consume as strong as they did before. There's been conversations, of course, about the student loans getting repaid, and that has taken some liquidity off or capacity for consumers and people to spend more. Obviously, we saw holiday sales, and that could be a little bit tricky. So I wouldn't put a lot of faith into what you're seeing in consumer sales because that's cyclical and it has to do with that. Let's dig a little bit deeper into this LEI index. And this is something that it's important as business owners to monitor. Very simple, the LEI can be distributed into three main components. The components that are lagging, the components that are coincident, and then the components that are leading, right? So what is really happening? We look at leading indicators, for example, like the yield curve, which is the bond market. We also like to look at purchasing manager indexes. What is really happening in the manufacturing and services industry? And then today we got, for example, claims, unemployment claims to really see what's happening with the economy. Those are kind of foretelling and help us look at what the economy is going to be looking. The coincident components has to do with earnings and GDP and jobs, and we like those indicators as well. However, they just kind of reflect what already happened in that coincidence. And then the lagging indicators, of course, it has to do with Fed policy rate. And of course, the Fed has been at the center of a lot that has been happening this year and also in 2022. And the markets, right, different from the economy, again, economy and the markets are different. The markets are pretty much driven by a lagging indicator, which is whatever the Fed policy does. And they also trade ahead, for example, in this case, because some commentary from some Fed presidents coming out saying that, we probably are in a good level. Other commentary from presidents today saying that more needs to be done, that the job and inflation is still not conquered, and therefore they're not ready to let that foot off the pedal, right? So at the center of everything that started everything pretty much post-pandemic is the inflation on inflation, right? Story on inflation. And what's interesting here is that we mapped the inflation that we experienced from the 1970s to 1985, and you can see a similar trajectory, right? Inflation is definitely not a one-way street to that 2%. And again, the Fed continues to hone in on the fact that it's 2%, not 3.5, not 3%, it's 2%. So if you look at inflation and the trends, well, yeah, we're in a disinflationary trend. However, the mistake that the Fed doesn't want to do again is to let go too soon and have a recap of what happened back in the late 70s and early 80s, that inflation flared up again, right? That's their number one goal. And that's why we don't believe that the Fed is going to step away from either keeping rates elevated or doing a lot of very aggressive rate cuts, because until the battle on inflation is not won, they're not willing to risk it. And then you ask, well, what are some of the components inside CPI that have been more sticky? And that's why we expect not a one-way street down. We expect to be a bumpier path, right, in the coming months. Obviously, we know that there were some steep declines coming from June and July of 2022 when it was peaking. And then we saw declines in goods and food and energy. However, it's mostly services inflation, that one that has been more sticky. And that is a big, big chunk of the economy. And that's why the Fed is still going to have a hard time giving up on this sort of tightening mode if it's not really clear that that inflation level is on a downward trend towards that 2% goal that they have. Another thing that has been really important for 2023 has been the sort of resilience of unemployment. Yes, it's starting to trickle a little bit higher, but not that significant, right? I mean, I would say anything below 4% is still considered, full employment capacity for the economy. So fairly well. Something that has surprised the Fed a little bit as well has been the reluctancy from companies, even though some of their earnings were declining, to let go of that human capital, right? It's been very important for companies to make sure that they have enough human capital to help them go through operations, because in the post-pandemic world, a lot of that labor force participation dynamic changed. And you can see the chart on the bottom half. It's been difficult, obviously, for the economy to maintain or to sustain a higher or elevated labor force participation. And we understand the dynamics, of course. Obviously, there's demographics involved, but there's also preferences of individuals to pretty much either decide to enter or not into the labor force. So those two things are going to be key for the Fed to look. Obviously, those are their mandates, right? Inflation, which we just covered, and now unemployment rate. And as long as the unemployment rate does not trickle higher, the Fed doesn't really have like a lot of support or ammunition to cut rates, especially if inflation is still not in their target, and then they're not really concerned about people losing their jobs yet. However, that's what we believe it's probably going to change as we move into 2024, especially if the economy begins to slow down and companies, when they're faced in a way to protect their margins, might start letting go of some of those people, excess capacity of people. Now, the story could be a little bit different for small business owners, and we're going to touch a little bit about that maybe in the Q&A section. Again, here, I wanted to show you the chart about job growth and what's really happening. So we had a lot of growth, of course, but not in 2021, 2022, but that growth in jobs has pretty much disappeared in the second half of 2023. Now, like Jason pointed out, there's a lot of individuals probably in this call that are part of the real estate industry, the housing industry. And obviously, this has been a topic that has been interesting for a lot of folks, as housing takes almost 20% of the economy, of the U.S. economy in regards to activity. And then, earlier in the year, we're going through a slowdown in housing. Some of that still remains. Looking at supply and demand, obviously, we can observe that inventories of housing have been declining significantly in the past 15 years. Demand, and that demand here is pictured by home sales, increased after the global financial crisis, but it's displaying this sort of V shape, right? Downturn and recovery during the pandemic. And now, of course, the big story is that mortgages have skyrocketed, right? And we clearly see supply and demand at play, and then obviously being a function of home prices and the cost of capital to purchase a new home, right? Or to refinance as well. So previously, we've had folks, right, in low mortgage rates that were able to refinance or take out new mortgages in the post-pandemic period. And now that they've locked into those rates, whenever they try to look at current rates, there's really no incentive, right, to upgrade or move out right now. And that's definitely a problem for that housing activity. And you can see it in the data that some of those households have decided to actually invest in their current home, either doing reparations or bringing in better appliances. So some of the story has been working inside your current home, given the fact that the cost or mortgage to get a new loan is quite high. So now that we know that we're in this sort of high mortgage interest rate environment, in this chart, what I'd like to point out here is the affordability. This is the orange line, has been advanced 12 months forward, and it's going to be acting as a leading indicator of what we expect to be home prices. What's going to happen to home prices 12 months from now? So the orange line has been advanced, and that's kind of like a leading indicator to what's happening. And as you can see, that affordability continues to drop, and it's a function of how much wage increases do you have, the cost of the houses, and then the interest rates, right? So higher rates definitely have been affecting and hurting affordability, which in turn then is going to affect home prices, and that can continue to cause weakness in the housing market. Again, let me backtrack here. It's a tale of two stories. We do expect some sort of recovery towards the end of 2024, but once we get into the recession here, We do see this sort of housing sector also suffer in the first half of 2024, given that affordability will still be difficult. And the Fed is probably not going to be so quick to cut interest rates. And I know that is different from what the Fed funds futures or the futures markets are telling us, and some of the rally that we've seen in the last couple of weeks about what the market expects the Fed will do, which is different from what the Fed has been telling us that they're going to do, right? So a point of caution there. This is what I guess it's important or really important to a lot of the folks in this call is a strong correlation between the 10-year Treasury yield and 30-year fixed mortgage rates. If interest rates stay higher for longer, meaning the 10-year because the Fed is keeping rates higher for longer, then mortgage rates will inevitably also remain higher. And that, like I said, is going to be a big hit towards affordability. And you can see the strong correlation. So what we mostly try to do is try to determine what the Fed is thinking about doing, and then what the market expressed via the 10-year yield is trying to do. And if we don't expect a lot of Fed rate cuts like the market believes, then we do believe the 10-year and 30-year will probably be higher towards the end of the year. But there's a recession kind of sandwich in between. So you're going to see yields fall, and then you're going to see yields climb back again. And we expect to see sort of the same story with mortgage rates. Consumer confidence, obviously, these are surveys. These are important because they kind of tell the sentiment of what's really happening. And there's definitely worries about weakening economic growth and then sort of this impending slowdown. Again, the whole soft landing, hard landing story that we've been hearing almost throughout 2023. Is 2024 finally the year where the recession happens? And you can see that consumer sentiment has improved slightly, but still remains below the levels in 2021. Small business sentiment, I know there's a lot of small business owners here in this call, has weakened more than it did during even the 2020, due to some of the uncertainties around inflation, interest rates, and economic growth, of course. And obviously, the capacity that those small businesses have to access capital, which is different from Wall Street. Public companies have the capacity to access some of that capital via public markets. However, small businesses need to go and tap banks for lines of credit, for loans. And we know that bank lending has been tightening over the past few months and is more difficult to capture and to take out loans. And that definitely puts a slowdown, of course, in small businesses, which is a big engine of the US economy. Just to finalize a couple more points here about the Fed, and real rates are important. So real rates are just a simple arithmetic subtraction where you grab the nominal rate in the economy and then you subtract the level of inflation. So let's pretend that nominal rates are 4.50 right now, 4.5, and you're going to subtract the level of inflation, which is about 3.5%. So that gives us about 1% of a real rate, right? So throughout the last couple of years, inflation has been climbing. Probably you've gone to Starbucks to get a cup of coffee, and you've seen the prices of that coffee rise over the past couple of years. Just because inflation is now tilting towards or trending downwards doesn't mean that you already suffer that cost, right? That cost has been embedded already into the economy, and now you're paying more for the cup. The fact that inflation is not going up means that you're not paying more for it, but the cumulative inflation that you already suffered as a consumer, if your wages haven't kept up, then you're really suffering from that. So real rates are in a way something like that. If inflation happens to decline faster than what wages are rising, then you have a positive spread in your favor, right? But if you are needing capital and inflation is going down and the Fed is not really quick to lower those rates, then the cost of that capital stays relatively high. And that's when we say that real rates are actually going to be detrimental to the economy because they're making it more difficult for the economy to function. Again, the goal of the Fed is to get that inflation level down. They're not really interested in minimizing economic activity. So the Fed is usually fast to go ahead and start cutting once they know that inflation has been conquered. And historically speaking, real rates have to climb closer to that 4% to tilt the economy into the recession. So we do have a little bit of room still for that to continue to happen. So what is the Fed going to do is the big question mark for 2024. In December 12, 13, we're going to hear from the Fed in the last meeting of the year. We're going to also get projections for 2024. and the markets are already expecting at least 4 rate cuts in 2024. However, we believe that the hurdle to cut rates is quite high, and we actually find it difficult to see if there is no recession in the economy in 2024, it's going to be very difficult for the Fed to cut rates. If rates are not cut, then we most likely see that the long end of the curve, the 10 and the 30-year, probably have to climb higher than what they are right now. And mortgage rates are also going to be affected, again, higher. If inflation doesn't move downwards towards that goal, and if economic activity doesn't really fall from that level. What to expect from the markets then? And as you can see in the far left column, we have something called 2024 year-end forecast. And this is the year-end 2024. Sandwiched in between now and the end is a recession again, where we do see risk assets probably sell off, and then some of that capital and money flow into more safe havens such as fixed income. But we do expect a gradual recovery towards the end of 2024. And that's why, for example, our targets for the markets are showing higher levels than what they are right now. We also expect higher interest rates from what they are right now, because we only expect 2 rate cuts from the Fed in 2024, not 4 or 5 like the market is expecting. It's important to understand something called the equity risk premium as well, and it's how much compensation investors are getting right now to invest in equities relative to fixed income, right? Fixed income is presenting really good opportunities right now at elevated yields, some of the best yields that we've had in the past 15 years. I know that a lot of investors probably have been sitting in cash or cash equivalents throughout 2023, investing in money markets, and that has been good. It played out well. However, if we do believe that rates are going to be moving over the next 6 months and then eventually doing something different, it could be good opportunities to get exposure into fixed income right now, lock in those attractive rates in a longer duration, and then evaluate really if right now is a good time to get more cash into equities based on how much you're getting compensated for the risk that you're taking into equities. From a portfolio perspective, of course, we at Wells Fargo Investment Institute recommend investors having a diversified portfolio that is according, of course, to their goals, to their objectives. And usually that diversified portfolio will include equities, fixed income, and real assets. Something to consider here is that the interest rate curve, the yield curve, is currently inverted, and we've never finished a recession with the curve being inverted. And that's why if we only have 2 Fed rate cuts embedded in the forecast for 2024, then the only way that you can uninvert the curve, make it positive again, is if you have higher yields toward the end. So again, it's going to be a first half that is going to be very dynamic in order for you to accommodate your portfolios. With that, I'll stop right there, Jason, and see if there's any comments or questions.
No, awesome. This has been very helpful, Luis. I mean, I learned a lot. I mean, I think especially, when we hear, you mentioned it in terms of hard landing and a soft landing, a lot of the traditional key indicators didn't really play out, right? You mentioned the employment rate has stayed fairly strong. We've seen just now, as we saw today, right? GDP growth continues to happen. So when we look at that, are you still, does a bank take a stance on whether it's going to be a hard or a soft landing? Because those indicators, whether they're not maybe those ones that you're looking at, we're talking about credit usage and even the consumption of things. We do know that people are spending a lot more than ever before on their credit cards, right? And savings are gone down as opposed to when we saw in COVID. So what do you see there? Because if GDP growth happens, companies aren't going to start producing as much, but employment is happening. I mean, it's still very up in the air, don't you think?
Yeah, the longer that we delay this sort of recession, we think it's going to be more detrimental to the economy, because real rates, like I mentioned, the more time that real rates stay elevated, it continues to be detrimental. And the Fed likes to say something about the lag of monetary policy. Obviously, rates have climbed very aggressively, and we're barely getting some of that influx or how we feel it as consumers.
Right. And we felt the first to get hit was the housing market, right? We have a question here that says, now rates near 5.75. Do you see a surge on loan applications? Are you starting to see that?
Not really. I mean, the data doesn't really show a surge in loan applications. I mean, again, who's really doing the applications, and you see a lot of movement in the high net worth space, of course, folks that already have, primary residence probably, but very different if you look at, other folks in different ethnicities as well as with different incomes as well. Not really seeing a lot of movement depending on how you separate based on income.
Excellent. What are some of the coaching that you're providing for individuals in terms of considering in this high interest rate environment with their investment portfolios? Obviously, there's still a lot of many financial institutions are throwing out very attractive percentage returns and such, for deposits, et cetera. What do you think about that from a long-term perspective?
Yeah, a little bit longer term. So past 2024, obviously more cyclical, 3 to 5 years. We think there's going to be a good opportunity to take advantage once the recession is here and we have this equity sell-off because people are going to be risk off. Good opportunity to lock in attractive rates right now. And then once the recession occurs, we'll probably unwind that trade and then move towards more equities as we take advantage of the early cycle recovery towards the end of 2024. Money markets have been great. Again, cash equivalents, money market funds, 3-month T-bills have been excellent and has been a good place for investors to park money there. However, cash in the longer term it tends to lag other assets like equities or fixed income.
Excellent. From a small business perspective, I mean, you mentioned obviously we're tightening of credit, the opportunity to obtain funding. What are you coaching your small business clients in this kind of environment?
Yeah, for small businesses, the fact that bank tightening is happening and that's sort of the source of capital for them. However, this has been a good opportunity post-pandemic to be more agile and resilient in the way that they manage their expenses. So we're seeing a lot of businesses that have been able to optimize the resources that they have, not really expanding unnecessarily. And if you look at the sentiment, right, from the optimism index, they've been very cautious to expand. They've been very cautious to manage their inventories as well. Not really thinking that is a time that, the economy is going to be booming and sales are going to grow. So I think they're handling well the things that they can control, which is their cost, their inventory, and the usage of their capital.
Excellent. And last question for you here. I mean, as we look at, of course, we talked about many in the real estate industry here. Are there any bright spots? I mean, considering I know both demand and inventory are at obviously historic lows, but there's still a gap between demand and inventory, right? There's still an opportunity for them to meet their that pent up demand. You mentioned kind of on the higher end. We know that at least from our end, from the Latino community, you have a lot of first-time home buyers still out there on the sidelines. Where do you see some bright spots, at least in 2024, if we continue with no rate changes from the Fed?
Yeah, I mean, the bright spot longer term is household formation, and millennials specifically. A lot of millennials, at least the higher cohort of that millennial cohort, has been able to get some housing, but there's still a lot of people behind the higher spectrum that haven't been able to get the house, and household formation will still be positive. So demographic trends in the sense that there's not a lot of building happening, right? There's still a lot of people that are undersupplied in regard to housing. So longer term, that'll be beneficial. We don't expect the rates to remain at the levels that they are currently in the longer term, because I don't think with all the budget, deficit budget that we have in the economy, with all the spending and amount of debt from the from the federal government, we don't think it's really sustainable. So most likely longer term rates will go down a little bit more towards what we experienced perhaps before the pandemic, and that will probably generate some more opportunities for that segment of the population to get into the housing.
So you're talking more 5 to 6, 6 and 5s?
You mean interest rates or
yes, interest rate, yeah.
Oh yeah, it could be lower than that. It could be even all the way down to 4, which I think is an appropriate level, depending on if inflation stays down at 2% and the Fed funds at 2.5, which is the longer term projection for the Fed. We could probably see that.
Excellent. Well, I think reading between the lines, you talked about household formations. Fortunately for us in the Latino community, we are a big factor in the economy driving those household formations. So we continue to do that. It's very important for this economy and the future of the of what we're doing here. For everyone, thank you so much for being here. We are going to send out an event survey. Please fill that out. It's just 4 simple questions that really help us a lot to be able to gauge your sentiment, really particularly about the economy, what you're seeing in your local market, for you personally as well. This has been tremendous. I think we're going to continue doing this. Luis, you've been a tremendous help being here and sharing this tremendous information, and we'll close out the year strong. And we will be posting, I believe, Melissa will share more information on that later on. Thank you so much. Have a great day.
Thank you.
Thank you.